$30,000. That's the maximum you can put into your super this year and still get a tax deduction. Sounds straightforward, right? Here's the part nobody mentions. That $30,000 includes every single dollar your employer contributes too. So if you're salary sacrificing $10,000 a year and your employer is putting in $14,400 through the super guarantee, at 12%, you've already used up $24,400. That leaves you just $5,600 of room. Add a personal deductible contribution of $6,000 and you're $400 over the cap. The ATO sends you a determination, and that $400 gets taxed at your full marginal rate, not the 15% you were expecting. Most people don't see it coming. They think about what they're putting in, not what their employer's putting in on their behalf. And that's exactly where the mistake happens. But the cap trap is only one part of the picture. There's a rule that lets you contribute far more than $30,000 in a single year legally if you know how to use it. And then there's a different trap waiting for higher earners that wipes out part of the tax benefit entirely, plus a decision most people near retirement get wrong: whether to put extra money into super or onto the mortgage. In this video, I'll walk you through each of these with actual numbers. Not theory, real calculations you can check against your own situation. Stay with me. Let me show you the actual numbers, because this is easier to see than to describe. Say you earn $120,000 a year. Your employer's super guarantee at 12% is $14,400. You've set up salary sacrifice of $10,000. That's $24,400 already in the system, and you haven't made a single voluntary contribution yet. You've got $5,600 left before the cap. Now let's say you read an article in May saying it's a good idea to top up your super before June 30. You think, I'll make a personal deductible contribution of $6,000. Feels like a reasonable number. But you're now $400 over the cap, and that $400 gets added back to your assessable income and taxed at your marginal rate, 32.5% plus 2% Medicare. That's 34.5% instead of the 15% you were planning on. You don't go to jail. You don't lose the money. But you lose the concession, and you pay a premium on top. Before you panic, this is not about blaming you. The concessional cap sounds like a limit on what you choose to put in. But it's actually a total that includes money flowing in automatically, money you never see hit your bank account. Most people only track what they salary sacrifice. The employer contributions are invisible until you log in to check. The fix is simple but requires one habit before making any additional contribution. Log into mygov, go to the ATO section, and check your year-to-date super contributions. The ATO updates this regularly, and it shows you exactly where you stand. What surprises people is that even a small overshoot matters. The ATO doesn't apply a grace period. The determination comes after you lodge your tax return, and it hits at your full marginal rate with no deduction available. If you're over 55 and thinking about topping up your super before June 30, hit subscribe now. Later in this video, I'll show you a rule that lets you contribute much more than $30,000 in 1 year without triggering that excess tax, and how to use it to gradually clean up your super structure for your family. You might think the answer is just to contribute less, stay well under the cap, but that means leaving tax savings on the table every single year. The better move is to understand a rule that most people don't know exists. Here's the rule that changes the whole picture. It's called the carry forward rule, and it lets you use concessional cap space you didn't use in previous years, going back up to 5 years. To be eligible, your total super balance needs to be under $500,000 on the 30th of June of the previous financial year. If you meet that threshold, the unused amounts stack up and you can deploy them in a single year. Let's put numbers to it. Say in each of the past 5 years, you only used $15,000 of the $30,000 cap. That's $15,000 is unused every year, $75,000 accumulated. This year, you can contribute your normal $30,000 plus the $75,000 carry forward, a total of $105,000. All of it goes into super at 15% tax. That's a substantial amount of money moving into a tax-advantaged environment in one financial year. I used to think the only practical way to improve your super's tax structure, specifically to reduce the taxable component that your adult children will pay tax on when you pass, was to do a lump sum withdrawal and then recontribute it as a non-concessional contribution. That approach works, but it pulls your money out of the market. You lose growth time, and you're exposed to whatever the market does in the weeks it takes to complete the cycle. I was dismissive of the carry-forward rule for years because I thought it was a niche strategy, but it's actually a much cleaner solution for anyone over 55 with a balance under $500,000. The carry-forward allows a gradual, year-by-year process. Each year you make a large concessional contribution, it goes in at 15%. It grows inside super. And when you eventually shift into pension phase, all earnings become tax-free. The proportion of taxable versus tax-free component doesn't shift automatically, but by adding more money in through concessional contributions and separately building the tax-free side through non-concessional contributions, you change the balance over time. The tax that would otherwise apply to the payout your family receives becomes a smaller share of a larger total. The long-term cost of not using this is real. Every year you leave unused cap space on the table, you're choosing to keep that money outside super at your marginal rate instead of inside at 15%. For someone earning $120,000 and contributing nothing beyond the SG, that difference is roughly 19 percentage points of tax on every dollar of investment return. You can find your carry-forward balance by logging into mygov, navigating to the ATO section, and looking under super. It lists the unused concessional cap amounts by year going back to the 2021-22 financial year. But here's the twist. Even this powerful rule has a landmine. If your income combined with your contributions pushes past $250,000, you trigger something called Division 293 tax. That's an extra 15% on those contributions. It catches even experienced investors by surprise. Division 293 is one of those rules that sounds obscure until it affects you, and then it's all you can think about. The basic mechanic is this. If your income plus your concessional contributions exceed $250,000 in a year, the ATO applies an extra 15% tax on the contributions that pushed you over. That takes the effective tax rate on those contributions from 15% to 30%. Not ideal when the whole point of salary sacrificing is to reduce tax. Here's a scenario that catches people out. You earn $220,000 from your job. That alone is under $250,000. Your employer's super guarantee at 12% is $26,400. Add in salary sacrifice of $15,000. Total concessional contributions $41,400. Income plus contributions $261,400. That's $11,400 over the threshold. Division 293 applies to the lesser of the excess over $250,000, $11,400, or total concessional contributions, $41,400. So it applies to $11,400. Extra tax, 15% of $11,400. That's $1,710 you weren't expecting. Now add a capital gain. Say you sold an investment property this year and received a $50,000 capital gain after the discount. Your income for Division 293 purposes is $270,000. Income plus contributions, $311,400. Excess over the threshold, $61,400. Division 293 applies to the lesser of $61,400 or $41,400. So the full $41,400 of contributions gets the extra 15%. That's $6,210 in additional tax on top of your normal obligations. This is not a penalty. It's a mechanism designed to claw back some of the concessional advantage when total income is well above average. The policy intention is clear. The problem is that most people don't include every income source when they run the estimate. They check their salary, forget the bonus, forget the capital gain, and then get a bill after lodgement. The practical response is to run the estimate early in the financial year. Add up your expected salary, bonuses, any capital gains you're planning to realize, and your projected concessional contributions. If you're approaching $250,000, you have options: reduce salary sacrifice for that year, shift some contributions to the non-concessional side, where Division 293 doesn't apply, or defer the capital gain to the next financial year, if that's feasible. So you've now seen 3 mistakes: the cap trap, the missed carry forward, and the Division 293 surprise. But there's one more that's more subtle, and it affects nearly everyone near retirement who has both super and a mortgage. Here's the question I get asked more than almost any other: should I put extra money into super or pay off the mortgage faster? The standard answer is always super, because the tax saving beats the mortgage interest rate, and mathematically, that's often true. But it's not the whole picture. Let's run the numbers. You've got $100,000 in spare cash you could deploy. Option 1, salary sacrifice it into super over a few years. If you're on $120,000, you save roughly 19 percentage points of tax on every dollar. That's the gap between your 34.5% marginal rate and the 15% super tax. Net cost to your cash flow, around $83,000 after the tax saving, and that money grows inside super at, let's say, 7% per year. After 5 years, that's roughly $116,000. Option 2, put $100,000 onto the mortgage at 6%. You save $6,000 in interest in year 1 and more as the balance drops. After 5 years, you've saved around $28,000 in interest, and you have a mortgage that's either gone or much smaller, and the mortgage offset account is accessible. You can redraw if you need it. The numbers favor super. But numbers don't account for sleep. I've watched this happen plenty of times. Someone near retirement sitting with $300,000 left on a mortgage and $400,000 in super. The super is growing well. The math says keep salary sacrificing, but every month that mortgage statement arrives, and the anxiety is real. That's not irrational. A paid-off home is a guaranteed monthly expense reduction and a form of security that Super Insider Fund doesn't replicate. I did this myself about 5 years back, split a bonus 50-50 between the mortgage offset and Super. It felt right at the time, and later when I needed to replace the car, I drew from the offset account instead of selling anything. The liquidity mattered. The reframe I'd suggest is this: instead of asking which option gives the higher return, ask which option gives you more options. Super locks your money away until you reach preservation age. Mortgage equity in an offset account is accessible anytime. A 50-50 split isn't optimal on paper, but it gets you the emotional win and the tax win at the same time. And it's a decision you'll stick with, which matters more than the theoretically perfect answer you abandon after 6 months. After all this, the cap trap, the carry forward, Division 293, and the mortgage question, let's bring it together into a checklist you can actually act on before June 30. Let me give you a practical checklist. 5 things in order of priority before the 30th of June 2026. First, check your year-to-date contributions. Log into mygov, go to the ATO tab, find Super, and look at your contributions for the current financial year. You'll see employer contributions and any salary sacrifice or personal contributions. Subtract that from $30,000. That's your remaining cap space. If you're already at $29,000, don't make a personal contribution thinking you have room. Check the exact figure first. Second, check your carry forward balance. Same place in mygov. Look for the unused concessional cap amounts going back to the 2021-22 financial year. Add them up. If your total super balance was under $500,000 on the 30th of June 2025, you can use those amounts this year on top of the current $30,000 cap. If you've got $40,000 of unused caps, you could potentially contribute $70,000 this year, all at 15% tax. That's a meaningful shift. Third, estimate your Division 293 exposure. Add together your expected taxable income for the year, salary, bonuses, taxable capital gains, any other assessable income, plus your projected concessional contributions, including the super guarantee. If the total is approaching $250,000, run the numbers before you make any more contributions. If you're already over, consider whether the extra salary sacrifice is still worth it at 30% tax, or whether it makes more sense to redirect that money elsewhere this year. Fourth, make a decision on the mortgage. This doesn't have to be permanent. It's a year-by-year call. Look at your remaining loan balance, your interest rate, your liquidity needs, and how far you are from retirement. If the numbers strongly favor super, great. If the mortgage is the thing keeping you up at night, it's fine to address that too. A split between the two is a legitimate strategy, not a compromise. Fifth, and this is where the carry-forward rule becomes a long-term tool, start the gradual clean-up of your super's taxable component. Every large concessional contribution you make now goes in at 15% and grows inside the fund. Over time, you can also add non-concessional contributions, after tax money, to build the tax-free component separately. The goal is to shift the balance so that when the money eventually passes to your family, the taxable portion is a smaller share of a larger total. You can't eliminate the taxable component, but you can manage it year by year without ever needing to do a full withdrawal and recontribution. One thing that catches people every year. If you're between 67 and 74, you need to pass the work test before you can claim a deduction for personal contributions. That means being gainfully employed for at least 40 hours over 30 consecutive days in the financial year you make the contribution. If you've recently retired and you're in that age bracket, confirm your eligibility before contributing. That's the checklist. 5 steps. The first 2 take about 10 minutes. The rest require a bit more thought, but they're all decisions you can make with the information you already have. Let's pull this together. The $30,000 concessional cap is not just a limit. It's a calculation that includes money you never chose to put in. The carry-forward rule is your second chance to use what you missed. Division 293 is your warning that the benefit shrinks as income rises, and the mortgage trade-off is a personal decision, not a purely mathematical one. None of this is complicated once you know the moving parts. The people who get caught are the ones who assume the system is simpler than it is. If you want more practical, numbers first strategies for your super and retirement in Australia, subscribe now. I post every week, no fluff, just the mechanics that matter. And if this video helped you see something you hadn't considered before, share it with someone else who's asking the same questions.